You no longer have to compromise on managing your private wealth. Now you don't have to choose between growing your portfolio or shrinking its carbon footprint. You can do both. You don't have to choose between enriching your own life or ensuring your family's future. You can do both. Or between the trusted service of a local firm and the global access of a multinational. You can have both. Because LGT Crestone gives Australian private wealth investors the best of both worlds. Visit lgtcrestone.com.au.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Checking where we finished up last night. Global stocks mostly positive as the US dollar and treasury yields crept higher. Gold and copper reaching new records. On Wall Street, the Nasdaq closed at a record high, while the S&P 500 also gained, boosted by tech stocks. Chipmakers such as Nvidia led the gains, with brokers raising the price target on the stock ahead of its quarterly results on Wednesday. The Dow was weighed down by falling JP Morgan shares after Chief Executive Jamie Dimon said he was cautiously pessimistic and said the company would not buy back its stock at current prices. Big box retailer Target fell after announcing it would be lowering prices on at least 5,000 frequently shopped items, with the company reporting its first quarter results later this week. And shares in Norwegian Cruise Line surged after lifting its annual profit forecast. Now, brokers have been upgrading their forecast for the S&P 500, with Deutsche Bank lifting its end-of-year target to 5,500 from 5,100, while Morgan Stanley forecasting it will hit 5,400 by June next year. Well, in the absence of any major economic data, markets have been focused on comments from Fed policymakers in the States. In regards to inflation, Fed Chair for Supervision Michael Barr saying, inflation readings in the first quarter of this year were disappointing. These results did not provide me with the increased confidence that I was hoping to find to support easing monetary policy. While Fed Vice Chair Philip Jefferson said it's too early to tell whether the recent slowdown in the disinflationary process will be long-lasting. Well, US Treasury yields have drifted higher, with the 10-year at 4.43%, the 2-year at 4.83%, and the US dollar has gained, the Aussie falling to 66.7 US cents. That's despite a rally in commodity prices. It is up around 3% this month. Let's get into what is driving US equity markets at the moment. Steve Sosnick joining us from Interactive Brokers. Steve, very good to catch up with you again. Well, as I mentioned, look, not a lot to trade on at the moment. What are your observations we're seeing with the market? I guess clearly the big one to come is that Nvidia result.
Yeah, great to see you again, Andrew. Nvidia is certainly the thing that everybody's waiting for. You know, there'll be Fed minutes this week. There'll be some numbers, but nobody really is in the mood to pay much attention to the secondary characters at the Federal Reserve, even though they're all telling a very consistent message. Cleveland President Mester said that she wouldn't even rule out a rate hike, but it wasn't really what the market is focused on right now. It's all about Powell. It's all about the Fed. But in the short term, it's about Nvidia earnings on Wednesday night our time, and that's really going to be the key. I hate to put too much emphasis on one stock, but we basically are in a situation where we're all AI traders now. AI enthusiasm has got a huge place in the market, and there's no other company that's more crucial to AI development right now than Nvidia. So that's really the focus, and I think we have another watch and wait day until 2 days actually until the numbers come out after the close.
Steve, there's certainly a lot riding on it, isn't it? And the company continues to raise guidance. It continues to beat that. What though? If there's even the slightest hint of a miss?
Well, that's the thing. I mean, this company, I can't think of any precedent for a company that routinely beat the raised numbers, raised them again, beat them again, and just kept this train moving. The problems I see are these. If they keep doing that, well, phenomenal. I mean, but bear in mind, the stock was under $700 last earnings, and now we're over $900 this time. So it's had a huge run. The other difference was going into last quarter's earnings, there was a bit of a sell-off. Actually, I will say I was one of the first persons sort of to get people to get a little bit nervous about it, and I did do it on air here among other places, saying, these can be very consequential. If they miss, we've got some real trouble. So the stock sold off 10%. Then the beat the numbers as usual, and we went up 16%. Now there's basically no concern priced in, at least so far, into the stock or its options. There's really not much demand for downside puts, relatively speaking. The stock is near all-time highs, but yet we've seen several companies beat on their EPS and then find, some modest reason for investors to sell off. It happened to Nvidia a couple quarters ago, actually, then resumed its advance, of course. But recently we saw with ARM Holdings where they beat on EPS and then the market didn't like not even the current guidance. It didn't like next year's guidance. So I think there's not a lot of tolerance for a miss here. And it's not even clear to me that they have to miss. They just have to be okay. And I don't know that that's good enough. If they continue to be excellent, good on you. Keep going.
Yeah, it's been an amazing ride, hasn't it? But Steve, are you surprised perhaps that, well, it looks as though, if the market was worried or nervous about that result, it's certainly not showing it at the moment. And I know you have a close look at the VIX, and I see you say that, is it complacency that we're seeing there at the moment, given that low volatility, or is there something else at play?
Some and some. I mean, we closed at basically almost a 5-year low for VIX on Friday. It was closed 11.99. It was the first time we had an 11 handle on the close since November of 2019, so 4.5 years. But some of it is complacency. I mean, I think right now we've gone from nervousness in April to froth in May. We wouldn't have had the meme stock lunacy that we had last week if the markets didn't have a bit of froth in them. But also what we've noticed there's been a huge popularity of funds that write covered calls. Well, if you're writing covered calls, it is typically a very it's a very risk-controlled strategy. You've raised income, you've defined your upside, but basically you're going to be no worse off than if you own the stock, and you're willing to give up a little bit of upside for income. That all makes sense. But when you started to see hundreds of billions of dollars dedicated to that strategy, it means that somebody has to buy that volatility. And that volatility is weighing on the market. Those calls that they're selling, they spill, even if they're selling them on ETFs, they spill into to SPX, where VIX is based off of, and it puts a weight on it. The problem I have with those kind of strategies are they work super well until they don't. And what happens is, when volatility rallies, it rallies fast. You go from 12 to 17 in about a half a day. And then it takes you, a couple of weeks to crawl back down. So that's really the question here: is how much is complacency? How much is just, supply and demand? There's certainly a lot of supply, and right now there isn't a lot of demand for protection either.
Indeed. Meanwhile, we've had a healthy dose of reality from JP Morgan boss Jamie Dimon. Cautiously pessimistic. How did you interpret his comments?
He's actually been a bit glass half empty for the last few weeks or months. I mean, he's sort of the mindset of, let's not get too crazy about things here. He's never been outright glum, but he's been the one. And if you go back through his statements, they've all had a cautious tinge to them. And I think that's not what the market wants to hear. No stock buyer wants to hear that the chairman of a company doesn't want to buy his own stock. He thinks it's a bit overvalued at these prices, which implicitly is what he's saying. So that's clearly not the best, advertisement for your stock price right now. But I do think that he recognizes that there are more risks out there than I think the market is willing to price in at the moment. The market is not thinking about risk right now. The market is thinking about if you have the balance between fear and greed, the market is pretty close to full on greed. Very low on fear, for the reasons we just discussed among them. And, that's I think where Dimon is trying to reintroduce at least a little bit of that equilibrium back into the idea of, wait a minute, not everything is perfect all the time, and you can't expect that it is. So it wasn't what his shareholders wanted to hear today. But I do think, if you read between the lines on his recent comments, he's putting a healthy dose of skepticism back into a market that really sort of lacks it.
So, Steve, are you prepared to take a position, particularly, I guess, ahead of that Nvidia result?
Well, I mean, I don't have a position on now. I think what I'm leaning to go is basically looking at the prices of downside puts, which are actually relatively cheap, which is another little tell. One of the things we saw when a lot of the other mega cap earnings came out a couple weeks ago was that when Tesla earnings came out, the market was quite risk averse. And Tesla, of course, rallied despite missing on every metric. But Elon Musk said enough vaguely futuristic things to get investors excited. So the next day we had Meta earnings, and there was basically no risk aversion in Meta. Guess what happened? Meta beat. Zuckerberg kind of poo-pooed the pace, the timing in which the billions that are being spent on AI might actually turn into a profit, and that stock went down. As a result, then we were very risk averse going into Alphabet and Microsoft. Microsoft rallied modestly, and Alphabet rallied tremendously. So we've had sort of everybody running to both, shifting from one side of the boat to the other in terms of risk ahead of these earnings. And so right now, insurance on Nvidia is relatively cheap. Insurance on the market, as we just discussed, is relatively cheap. The one thing about buying insurance is you don't necessarily hope it pays off. Nobody really wants their homeowner's policy to pay off because if it was a fire in your house. You're happy to write that check and not have it cash in. But so that's kind of how I'm approaching the run up to Nvidia earnings. Is you can buy insurance at very, very reasonable prices, whether it's on Nvidia, which is not cheap but relatively so, and certainly on the broader indices, which in fact are cheap.
Well, Steve, we can always rely on you for a healthy dose of reality. Thanks for joining us from Interactive Brokers.
My pleasure as always, Andrew. Talk soon.
Cheers. Let's just take a quick look at where we're likely to get going in a couple of minutes' time. SPY futures, they are off marginally there, down 9 points as we prepare for the open, which is just a couple of minutes away. Stay with us for that.